bunch of y'all. There we go. Love it. All right. Hey, let's do this. That's absolutely. So let's talk about tax planning. When people think about tax planning, and I'll go over and I'll tell you kind of how this afternoon will look. I'm going to do a lot of tax knowledge so you understand, get rid of some of the misconceptions out there. I'm going to go over the different types of income so you understand how things are taxed and why real estate is so different, and then the different types of real estate. We're going to go into some deductions as well to put some money in your pocket, but we really got to start with this high level looking at tax planning. And so I'm going to break it down to you like this. I'm going to say that when it comes to you and me, and let's just say here's us. The way it works for us is we earn money, we're taxed on that money, and then we spend what is left. So I'll just ask you guys a simple question. Does anybody have kids out there that they have to pay for things, where they're actually having to pay for somebody going to college, or you're paying for somebody going to high school, you're paying for somebody who's going to do something, right? Because if that's the case, I'm going to show you a way to get some money to them tax-free, because it's the same theory. We have to earn money to spend money. So if we have, let's say, $10,000 of tuition, or it could be a cell phone, it could be equipment, it could be a computer, it could be just, hey, I have things that I have to pay for, and we have to make enough. Then I look at the tax foundation, which says between federal and employment taxes and state taxes, you're paying about a third on average for taxes. So I'm just going to say we have to earn $15,000. We have to pay tax on $5,000 in order to have $10,000 left to spend. Let's compare that to our friend, the business. A business earns money, then it spends money, and then it is taxed on what is left. You notice that little difference? We just shifted it around. What if I told you that a lot of the expenses you're already covering and that you're already paying for right now could be paid with tax-free dollars? Let's just say that a business earns $10,000 and it spends $10,000 on equipment for your children, maybe paying your kids, maybe doing some things that, transferring that money over, or just covering expenses for your business. How much tax do you have? Zero. So what's our net savings? About $5,000. And that's all tax planning is. It's shifting things around a little bit. You're probably already spending the money. It's just figuring a way to get it to yourself in a tax-free method. And by the way, when you pay your kids, this is the example I gave, that's because they have a standard deduction of $13,850 that you can pay per individual kid. And I say kid, it could be adult children too. You might have some employment taxes on people over 18, but you could pay somebody, parents, brothers, siblings, friends, whatever, if they're involved in your business and you pay them, they can make up to $13,850 a year without having to pay tax on it. So if it's our kids, that seems like a no-brainer. If we have children that we're paying for college and things like that, if we can get that money to them, their tax rate on that is a big whopping zero. And we just gave ourselves a deduction because we are treating ourselves as a business. And that's the trick. How do we get there? That's what this afternoon's all about. Now, before we get into that, let's just talk about Anderson real quick. I know Clint did a fantastic job this morning. In fact, what do you guys think of how Clint did? Give me an emoji that represents how you thought Clint did. Got some hearts. A lot of thumbs up. Somebody's crying. Got some confetti. He did a fantastic job. He does a really good job of taking complex information and making it pretty understandable. He is, yeah, somebody says he's an excellent presenter. Been working with him now since, what is it? It's going on 26 years. So, and we own a ton of property together. When we say we own a ton of property, hundreds of properties, including commercial buildings, manufactured home, self-storage, single families, duplex, 8-plex, 12-plex, commercial buildings. We own a couple buildings as well, just to throw that in there. Some warehouses, mobile home parks, if you name it, we like to do it because we like to do what our clients are doing, and we follow you guys around and listen to you. And frankly, I steal all your information off the tax returns, and I can see where you're making money, and I go do the same thing. So if I see a bunch of clients and they're making money on shared housing, guess what I'm going to do? I'm going to go in there and say, hey, you guys are doing really good. Where are you going? RV parks are great too. A lot of people are converting RV parks into storage. A lot of different strategies out there right now in real estate, especially. There's some ones that are just blowing the doors off, and then there's ones that stink. But the only reason I'm bringing this up is I want to bring it back to Andersen. Andersen's not just some company fly by night. We've been here doing this for 25 years. And we look at our relationship with our employees and our clients kind of like a triangle. You got to make sure the business and the employees and the clients are on equal footing, all different, the sides balance, because one of those things being out of whack really causes you problems. And so we've received a bunch of culture awards, including the Values Award for mid-sized businesses in Nevada. And I just bring that up because that's important to me as a business owner, that my employees feel good and that our clients feel good and that I feel good. Like, it has to really work that way. I'm a best-selling author on Amazon, and I believe Clint just did as well. And we are an Intuit firm of the future. In other words, we have groups that recognize our values, which I'll just give them to you. Integrity is one of our main values. You know, you always say, what is integrity? It's integer, it's being yourself. Innovative, we look at always trying to, what can we bring to bear to make our clients' lives easier? That's how we got this one, because we use technology to benefit your lives. That virtual bookkeeping and doing bookkeeping remotely are really important. Conscientious, doing things with knowledge. Being resilient, bouncing back. Even during COVID, we were a live event company doing 50 events plus per year live, and we switched to the online, and we had to retool and look at how could we deliver very valuable content from afar. And we were not, that's not what we did. We were sitting here, we would be face to face. We'd have 3 days covering information. We'd sit down with people. We'd have conversations. We had to translate that into a different format. And we were able to do that successfully. And it enabled us to lower our prices considerably so that we can reach more people. And then we're driven towards a goal. And our goal is really simple. We want you to be successful because it makes us more successful. If you make more money, we do better, because if we're your asset protection person, we need assets to protect. If we're your legacy people, we need to be able to create a legacy. We need the tools to do that. If we're your tax planners, sorry, there's no tax planning on people that don't make money. So we really need to have you guys get successful, and we take that very seriously. Part of that seriousness is we give out a ton of free content. We go online and we constantly, like I'm saying, like you could just look at this. I have 590 videos up on my YouTube channel. Please subscribe, click the little bell. I put out about 3 a week on different topics, including we record something called our Tax Tuesdays, where people come in and ask any tax question they want, and we answer them. So you can see what everybody else is asking. You can watch. How many of you guys been to a Tax Tuesday? How many of you guys have watched Tax Tuesday? Is there anybody out there? And would you recommend it to other people? I think they can see the emojis. I'm not sure, but if you could give me an emoji as a thumbs up or something, just to let us know that that's a pause. A bunch of people are putting it in chat too. Thank you very much. Yes. What I care about, again, is sharing information, making people more successful, because Clint said we don't need to be doing this. And that's not a sly, mean thing. It's because we've been very, very blessed, and we're very, very lucky in real estate. We have a great business. We have great employees, but Clint and I still come out and do these events because we like to teach people. And that's the God's honest truth, is we like to go out there and we like to see if there's somebody says Tax Tuesday is awesome. Thank you. And it's free, guys. I'll show you how to get to Tax Tuesday as well. But there's my YouTube, and then there's Clint with his perfect hair. He does a fantastic channel where he's talking all things real estate asset protection, over 390 videos. So like, if you want to learn this stuff, there's not going to be somebody got that. There's not a lack of the ability to get to information. We believe in giving out. We're an educational firm, which is very different. A lot of attorneys make their living hiding the ball and not getting their clients educated, so that the client always has to come back to them. That's not us. We want you guys to be very, very educated, so you recognize value. And then when we give you something that's of great value, you go, that's great value, I'm doing it. And we don't have to haggle. We don't have to think about it. You're able to do it. Speaking of which, during the break, I know some of you guys were trying to get through the website, that sometimes it gets clogged because there's too many people, or you have issues with your credit card or things like that. Do not worry. We can see you. We know that you are here. And the whole intent of doing that isn't to have a, hey, let's have a time pressure. No, it's to reward the people that are physically on. And the only way we can do that is by doing it for a short period of time. And we also know that it gets taken advantage of, so we can only bring in so many people. So we say we're going to open that spigot up for 30 minutes, maybe once every other week, and that's it. It doesn't get offered any other time. But if you were there and you were there, like, we will honor that intent. We will honor it. If you are like, hey, Monday, something comes around, reach out to somebody, let them know that you were trying, and we will work with you. We're not mean people. But we do want to benefit, like, we do want the spirit of that to carry through. We want to reward the people that were physically here, and we're trying to take advantage. And that's you if you tried. Right. Tax Tuesday, free. You see there, Jeff Webb, a wonderful accountant for 40 years, CPA that I do the Tax Tuesdays with. Some of you guys know Jeff has been battling cancer and comes on periodically. He's a true warrior. He's my cohort in Tax Tuesday. Elliot sits in when he's not there, sometimes Kurt, but the premise is still the same. We've done almost 200 of these guys where we answer your questions live. We don't mess around. And like today, by the way, I have to do a shout out to my guys. They answered over 720 questions. I have a whole bunch of attorneys, some accountants, and some support staff answering questions for you guys. They don't, like, this is not a moneymaker. We are literally just giving that away, and we do the same thing on Tax Tuesday. And I say that sincerely, that if you are one of those people that you have a bunch of tax questions, you don't have to be our client, just come get it answered. And the reason is, I'll show you what the reason is, because I have a certain belief system, and you'll catch on to that quick. Why are you here? That's a good question. It's like, why are you here for taxes? What are you thinking about when it comes to taxes? Why should we do tax strategies? Maybe let me know in a chat, and I'll read a couple of them off, because what I'm really interested in is like, hey, is it because, hey, I just want to pay less, or hey, I feel like I can do more with that money. Hey, I feel like I'm getting oppressed by the government. Somebody says the government mismanages money, which is, I'm not going to disagree with. I think you guys do a lot better at wealth planning. You know, it's funny because taxes take many forms. We always think of income taxes, save money for my retirement and charity. That's why I love you guys. We see that all the time. I want to pay less taxes legally. Yeah. But why? Why, Jorge? Why do you want to pay less tax? What are you going to do with that money? What does it mean to you? Does it mean, hey, I get to spend more time with my kids, I get more freedom, I'll be able to retire early, I'll be able to give more back, I'll be able to coach a soccer team or something like that. I'd like to be able to have more time. What does it really mean to you? Because that's the motivator. That's what's going to make this thing hum, is when you dial into that big old why you're doing it. Want to be proactive as I build a business, and want to get the most from the money I earn to do more with my family and help others, especially young girls. Dominique, 100%. I just love that. New investor, need to get educated and grow, wealth legacy, time, freedom, and donating to good causes. Yep. And I'll be able to spend more time traveling and on other hobbies. Get that too. Love it. Here's the problem with taxes, and I'm just going to use this as an example. I use this for investing as well, but you just kind of look at these things. When you're in a taxable world, like this is taxed at 25%. Your money doesn't grow as fast as when you do it in a tax-free, it could be deferred or tax-free. I was thinking deferred, tax-free, tax-deferred. So this is like your IRA, this is your 401k, this is your defined benefit plan, this is your IUL. Look at how it grows. This is $1 doubling 20 times. So I just use this as an example. Compounding, you figure your interest rate, divide that into 72. That's how often your money doubles. If it's being taxed at 25%, then you can see the effect of what that doubling would do. It would be really neat if we had $1 that doubled every day, but obviously it doesn't, or that money that doubles every day. But whatever that period frame is, you're just kind of looking at it going, all right, look at the difference in, like, after 10 doubling, we'll just call it 10 doublings, which might take you 50 years, maybe it takes you 30 years, whatever, however good an investor you are, you just see a huge difference. It's twice as much after 5 doublings. So we want to get into this tax-free compounding, and tax-free compounding doesn't have to be in a retirement plan. It could be simply because you're a real estate investor. And I'm not misstating that. Real estate investors voluntarily pay tax, because if you don't want to pay tax, there's a way that you could eliminate your tax forever as a real estate investor. Now, there's actually a number of ways, and it's just how much commitment you'll make to that particular endeavor. The other thing I look at is I think of taxes as a loss and how much I have to make back to equal that loss. So if I have a 20% tax on money, I have to make 25% on what I have left just to break even. I think about that a lot. I'm not against paying tax, but what I'm against is when I see people getting into this realm and this realm, just look at that. I have to have 100% gain. If I have a 50% tax because I live in New York or California and the feds take 37%, the state takes 13%, and I'm just getting shellacked. And then you say, why can't I get ahead? Why can't I retire? This is why. It's insidious, but it's true. So I spend a lot of time figuring out, okay, what can we do to minimize tax so that I don't have to go through that route? It's so much easier to become financially successful if I don't get hit with it. So let me ask you guys a quick question. Do you have positive thoughts about paying taxes? What do you think of when I say the word tax? What comes to mind? I know some people are doing crying. Hey, you could do it via emoji, but you could also do it via pain, sweat, anger. You could do it via chat. Confusion. There's a lot of confusion in the tax world. Fear. What if I told you that the tax code is about 5% on how to pay on the taxes you have to pay and 95% on how to avoid them? That's about right. The tax code is not horrible. The tax code can actually be your friend, but taxes take many forms. And I want you to think about this, because taxes aren't just income taxes. Taxes are also inflation. And how do I know? Because I can track the CPI with the money supply. You notice those graphs look kind of like identical. Like we could put the price of housing on this and it would be identical too. Like it's literally, when they print more money, our money goes down in value. That's a tax. Oh, I know you're thinking tax. Other way to look at a tax. Well, I look at Monopoly. I love Monopoly as an example for investors. But if you've ever played Monopoly, you'll notice that there's two areas where they have that tax. It hits you. You're not buying it. Like you land on it, you go, oh. So it's kind of a negative feeling, right? Oh, shoot, I have to pay taxes. I don't look at it that bad. I say, hey, if I'm paying tax, it means I'm making some good money. I just don't want to overpay my tax. I have a sweet spot, which we'll get to. And I just say, hey, some of you guys think of this, right? You think, oh gosh, I better not do anything because it's illegal and they'll put me away for life. It's not like that, guys. It's not like that. In fact, I'm going to show you the truth about taxes, which is you'll likely never get audited. And there's ways to avoid audits 100%. And I'll show you those statistically. You don't just have to listen to me. I could actually show you on numbers from the government's own data, who they audit, why they audit. We already know. And we could take you into spaces where they don't audit. How do I know? Because we've been doing this for 25 years. We do over 10,000 returns a year, and we get a handful of audits every year. It's a fraction of a percent. So if you don't want to get audited, get structured. I'll show you why. Right. This is Justice William Rehnquist. This is a quote. There's nothing wrong with a strategy to avoid the payment of taxes. The Internal Revenue Code doesn't prevent that. I want you to think about that long and hard. There's nothing wrong with doing a tax strategy to avoid payment of taxes. There's zero. You can absolutely take matters and reduce your taxes. What if I told you that paying taxes could also be voluntarily? It's voluntary if you want to. And there's two things that we look at. When we look at how much tax you pay, it's really two big things. I'm just going to write them down. Number one is knowledge. The more you know about the tax code, the less tax you'll pay. How do we know? Because we have really, really wealthy people making billions of dollars who don't pay a lick in taxes. There's companies making billions of dollars and they don't pay taxes. Why? Because they have a team of attorneys and accountants finding ways to not pay taxes. Number two is the willingness to change. To adopt new income sources to take advantage of the incentives. So I'm just going to call it your willingness to change. So for example, if you are just a W-2 employee and you're making money and you're saying, geez, I'd like to pay less taxes. Well, okay, if you just keep things the way they are, like you make no changes whatsoever, it's not going to have an impact. But if you use some knowledge and you learn about things like HSAs and IRA and charitable contributions, and you learn about possibly side gigs, and you start saying, hey, I'm going to embrace some of those things, and you're willing to change, those are the things that will reduce your tax bill. If you're not willing to do that, then it's not going to happen for you, right? And I'll give you some examples here in a second. But the amount of tax you pay is specifically reduced by your knowledge and your willingness to adopt to change. How many of you guys are willing to learn more about taxes? And if you see something that will change your situation, you have a willingness to adopt it. And yes, okay, I see a whole bunch of thumbs up. I see a bunch of, yep, and I see people in the chat. Good, then you're in the right place. And let me give you an example. I'll give you an example for real estate. In real estate, there's this thing called depreciation, which you're going to learn today. And what depreciation does, it's a deduction. And it makes your rents tax-free. In other words, I can make money, but because I have this asset that the IRS allows me to take deductions against, and it's based on the improvement value of that property, I can literally have tax-free income. Let's say that I buy a house for $300,000. And over the years, that $300,000 house goes up to be worth $600,000. And I get an offer for $600,000 that I just can't refuse. And I know that there's other properties out there that I'd rather be in, or like maybe I bought it let's say I bought in Seattle and the market jumped up, but I know there's cash flow properties in Indiana or Kansas City or Winston-Salem or some of these other places. And I say I could buy 3 properties and get more cash flow. Well, then you can do what's called a 1031 exchange. And a 1031 exchange means swapping real estate. And it doesn't have to be just one property. It could be multiple properties. You could just sell this guy and pay no tax on it so long as you spend the $600,000 at least on additional properties. So let's say that you buy 3 $200,000 houses, and we'll use Charlotte, North Carolina, because that's been a hot market that we've been in a long time. So that 1031 exchange, how much tax did you have to pay when you did it? We swapped it, and it's tax-free exchange. So we had 0. So just keep in mind, we increased our income. I mean, our asset value, our net worth went up $300,000. We now have $600,000 of property. We're producing rents out of these. So there's lots of rents. And if we know what we're doing, we're using cost segregation and bonus depreciation, and we're not going to be paying rents for the first 10 years or so. And I'll show you how to do that. So you're getting tax-free money, and the value of those assets is going up. Let's say that those assets go up in value. There's 3 of them, and they go up to $300,000 each over the next 5 years. So maybe 5 years, 10 years, whatever it is. So now you have $900,000 of property, and you need some money. So you borrow. Let's say you borrow $300,000 so you can have some cash. What's the tax rate on that? There you go. It's 0. So you had 0, 0, 0. And you're saying to yourself, wait a second, I know there's a catch. Well, someday you die, right? So then you pass away. Do you know that your heirs get a step up in basis? And what that means is the basis of those properties is now, let's say you passed on the year and they're worth 900,000. Their basis is 900,000. If they sell them for $900,000, their tax is 0. That's how this stuff works. I just want you to understand why when people say, hey, real estate investors don't pay tax, this is exactly why. It's because they have these types of options here. I'm going to erase all the ink on the slide. Now, what about a business? Now, I already told you that businesses earn money, then they spend, and then they're taxed. Well, you're going to need deductions anyway. Like, you need to have your internet, you need to have a cell phone. And by the way, if I set up a business, a true business, not a sole proprietorship, I don't play that. I actually go to a corporate entity like an S Corp or a C Corp. I can write off my entire phone and the data 100%. If I'm playing the game with, hey, I think I'm using it for investment and maybe some as a sole proprietor, they're going to make you track how much of it is business use versus personal use. We don't want that. So you're going to have these expenses anyway. So you're going to get it. And then if you don't want to pay tax, do you know that you can defer money into a retirement plan based off of the income that you've been receiving? Like, a lot of times we hear this thing called a 401k or an IRA, and those are examples of something called a defined contribution plan, where you're defining how much you put into them by a contribution limit. In a defined benefit plan, we actually have clients putting upwards of $700,000 a year into their retirement plans. These are almost always $100,000 plus, because instead of calculating based off of some arbitrary figure like $6,000 is what you can put in, or hey, you can put in $66,000 total in a 401k. These ones say, how much have you been making and how much do you need to have in your retirement plan to continue to make that? So if you're used to making $150,000, $200,000 and you're in your 50s, you might have 10 years to put $3 million into a retirement plan. Just do easy math. That's about $300,000 a year that I could do that. So with a business, I am able to make huge deferrals and avoid the payment of taxes. And then some of you guys are smart and you're like, but wait a second, you still have to pay tax when it comes out. Not if you don't want to. You could actually you could set up a charity and donate the money directly into a charity. There's a charitable donation rule where I can make it directly out of a retirement plan like an IRA, up to $100,000 a year. And that counts as my required minimum distribution. The other route we do is, hey, we become a real estate professional and we generate losses one year, and then we convert the retirement plan from a tax deferred plan into a tax-free plan like a Roth. That's why you like your tax planners. Your tax planners become your best friends, because your tax planners have, remember what we said? Your tax planners have a lot of this. And all we care about is, hey, are you willing to make some changes? Are you guys willing to make some changes if it equals big tax savings? That's your big question. I see some thumbs up. All right. You may not even have to make any changes, right? First off, we could just do make no change. A lot of you guys, we might be able to find a bunch of tax savings just looking at finding things that you're already missing. So for example, if you've ever looked at the tax charts, like I have one sitting here next to me, you might notice, you might go and say, hey, what's the tax rate for capital gains? And you realize that if you're married filing jointly, the first $90,000 you make, if it's capital gains, is zero tax. I have this every year. I go crazy because I have people that make $50,000, $60,000 a year and they have capital gains, long-term capital gains that they're sitting on. And I'm like, sell it. And they're like, but I don't want to sell it. I'm like, then buy it right back. Sell it and buy it right back, because it resets your basis to the higher amount. It's tax-free. You'll never pay tax again on that. You could even borrow against those securities if you want to with the security-backed line of credit, which we've already established is zero tax. Please do something. And those are easy ones. The other one is things like missed business deductions. Hey, are there things that you should be writing off with your real estate, for example? Like, we already know that there's a ton of deductions that you get with real estate. Hey, if I'm retiring a roof, did you write that off? Hey, are you writing off the real estate taxes? Believe it or not, we see people miss that all the time. How about, hey, are you driving around in a car? Are you reimbursing yourself mileage? There's management fees, there's legal fees, there's advertising costs. There's even a home office. Are you writing off your home office? Well, I don't want a home office. I heard that you lead to lots and lots of audits. Well, you're not a sole proprietor. We're going to do an administrative office for the home, and I'll show you how to write off about 20% of your house. all the expenses, including your utilities and your internet and things like that. I'll show you guys that one before we're done today. Insurance, home office. Hey, are your kids working in your business? We already hit that one on slide number 1, right? Why don't we bring those kids and get them some money where they're paying tax at a lower amount? That's called income shifting into the lower brackets. But there's missed opportunities, and you don't even have to do a bunch. Here's another one. If I have real estate, a lot of you guys have been taught that your real estate is depreciated if it's residential over 27 and a half years. How many of you guys have heard that? Hey, if I have residential property, my accountant tells me I have to write it off over 27 and a half years. Let me know. Just give me a sign. It could be an emoji or whatever. But how many of you guys were told by your accountant, hey, 27 and a half years or it's commercial, it's non-residential, it's 39 years. That's okay. You're allowed to do that, but it's not the methodology you're supposed to do because it costs you more money. The IRS lets you do it because it costs you more money. And that's just called doing something called a cost seg, where we're breaking the property into its components, which means, hey, I don't want to write it off over 27 and a half years. I want to write some of that stuff like the carpeting off over 5 years. I want to write off the improvements. Like if I put in a driveway, that's 15-year property. Only the structure in a residential is 27 and a half, and they miss it. So we're going to give you knowledge so that you could figure out whether you're in one of these situations where you're paying taxes voluntarily, and we're going to remove it. And some of you guys are going, wait a second. I'm going to go over this in detail, guys. We do cost segs all the time. Our firm doesn't do them. We outsource them to a great company that's all they do. It's a CPA firm that does nothing but energy credits and cost segs. And we have so many clients that use it. We've just become really, really good friends because we're like, hey, why pay tax when you don't have to, right? You voluntarily, you want to write a check to somebody, you know, it might not be the government, maybe it's not your favorite, but you have all these things. Medium stuff is like, hey, maybe make small changes, like add a corporation, like you just added a business to your structure. You just did it. Like if you became a Business Essentials client, you're already starting down that path. And so an example might be a corp, an LLC, doing something. Maybe I'm a sole proprietor and I make it into an S corp. I'll show you how that works. So maybe we do an S election so that we don't have to pay tax on 100% of our employment taxes. Maybe I invest in real estate. You start hanging around these real estate investors and you realize, hey, wait a second. They treat real estate differently than anything else. If I buy a bunch of Microsoft, I don't get a deduction. I buy a bunch of real estate and I can write it off. What the heck? Yeah. You might be looking at, hey, do I go to dividend paying stocks because they kick off capital gains as part of the dividends, and it's taxed as long-term capital gains, and my long-term capital gains rate is 0. So I get tax-free money. Maybe I'm going to do that. And by the way, if you want to learn about these guys and you don't know about them, go to infinityiinvesting.com. It's an Anderson company, and we teach people how to make money. It is my little baby. I wrote a book called Infinity Investing. If you want to learn how to make money in a tax advantage way, by all means, go there and absolutely spend some time. There's a free membership. You can learn a whole bunch. The hard stuff. All right, now we're talking about, hey, I'm going to do some heavy lifting. I'm going to make some major changes. Maybe I'm shifting to a 501c3. Like, let's say that I'm doing certain type of housing. I'll use me as an example. If I don't want to pay tax and I'm like, gosh, I'm getting killed and I have a whole bunch of active income, I need charitable donations because they'll offset active income. If I'm not a real estate professional, I have very few options, but this is one. So maybe I set up a 501c3 to do affordable housing or shared housing or recovery housing or autistic housing or residential assisted living for our elders. Whatever the case, I say, you know what, I'd really like to get involved in that. And I donate one of my old houses that I've already depreciated to the charity. I just did this. I do this almost every year. So I'll give you guys a real live example. So I had a client, it's actually not a client, it's a friend, because I've known him for years, and he's a bit of a knucklehead, and he and his wife were real estate investors, and in 2008, they made some mistakes. How many of you guys were investing in real estate in 2008 and made some mistakes, and now you're coming back, right? You're realizing, You're like, oh, I'm never going to do that again. Well, they were in Florida, and they pledged mom's house on some investments that went south. And the bank ended up foreclosing on mom's property. They fought for years and years and years, and eventually mom lost her house. Mom is 80, and she's blind, and that's her house. So my buddy was like, hey, Toby, can you do anything? And I said, yeah, I'll go to the bank and I'll buy it. And you maintain it, and eventually you can buy it from me. And he's a knucklehead, of course. He's a wonderful guy, but he's a knucklehead. Never maintained it, never bought it from me. But I bought the house for the mom. I think I paid $90,000 from the bank. I went there and negotiated with them. House was in disrepair because he didn't touch it when they moved out. Mom had left, was staying with his sister, and then they came through and they fixed it up. Right. Well, a few years later, I'm sitting here going, hey, mom's never going to pay tax. Like, I'm never going to charge that lady for her house. I'm sorry. I'm just not going to do it. And I had to, if I am in the for-profit realm, I have to attribute a certain amount as though I'm gifting her money, and I have to recognize some rents, even though I'm not receiving them. So I moved it to the charitable realm. So I donated the house to a charity, and I gave her a life estate to stay there, not a true life estate, but the ability to occupy that property without paying rent until she's passed or until she leaves. Just the right thing to do, right, guys? Like, you got to take care of folks, especially when they're in that situation where they don't, like, I can't imagine somebody who's blind, who's been living there for 30 something years, and then the bank boots her onto the street or something like that. I just couldn't imagine that. So that's not on my watch, right? I have the ability to do something, so I'm going to do it. Well, here's the interesting part. The tax deduction that I received for that donation was $300,000. It was $310,000 is what it appraised at. So it's funny how the world works. I'm in the top tax bracket just because I make a lot of active income. That offset about $120,000 plus of my tax bill, more than what I paid for the house. I just want you guys to let that settle in. You can do stuff. That's the hard stuff. That's when you're getting in there. The other route you can go is something called a real estate professional, where you spend more than 750 hours a year in a real estate trade or profession, and you materially participate on your real estate. And I'll go over what that means, but I just want to give you a nutshell. It means that any losses that you can create from real estate will offset your active income. It'll offset your W-2 income. So when you don't want to pay taxes, and I'll tell you, I sat in a class just like this, it was live, and there was a surgeon and her husband sitting in the room. And when they realized that they qualified as a real estate pro, because her husband managed a bunch of their real estate. It was up in Seattle. She was a surgeon. She was making close to $1 million a year. And the deduction that they realized that they were entitled to, because we did a cost seg, and the loose number is you're going to get about 30% of the improvement value as a deduction in the first year. And she was like, you got to be kidding me. It saved them $183,000 in the first year. Not deduction, saved them that money. But this is the hard part. You got to be a real estate professional. They'd already done that hard part, and they just didn't realize it. So you can be a real estate pro. You can quit working and start leveraging your asset. Like, hey, I have a big stock account. Maybe I have a big Bitcoin account, whatever, and I borrow against it. And you can borrow against any asset. It's not just real estate. A lot of us think HELOCs are the only game in town, or we can take leverage against only real estate. No, you could actually do what's called a security backed line of credit, and you could borrow against any of your stock accounts, any of your assets. It's absolutely fantastic. Somebody says, hey, can I get the program now? Everything that I'm mentioning here, by the way, is in that tax toolbox. When Clint says there's 20 videos, there's actually more. Because what I do is I keep going in and recording more stuff, and I keep adding it to the tax toolbox. In fact, we did what's called our TaxWise workshop, where we go over every deduction that is listed on this page. There's 44 deductions right here. There was 45th, which was conservation easements, which we nixed this year because they limited them to 250% of the value of the land, which topic for another day. But there's 44 specific tax deductions that are also video from our offices, where it's Elliot, myself, Kurt, and others that are going into each one of these in detail. That is also in that tax toolbox that you get if you are taking advantage of the Business Essentials package. So I can't stress to you how much stuff and how much content you have at your fingerprints. If you want to learn about any of these things, you can do a deep dive. You can go onto the YouTube channel. You can go to the Tax Tuesdays. You can go into the Tax Toolbox. You can talk to us. You can write us if you're platinum. If you're a tax client, you can have conversations with them, with our tax professionals if we're doing your prep or if we're doing your bookkeeping. But there's absolutely no reason why you can't continue to do the learning process if you want to do it. We're going to make sure that it's there for you. Anybody who's been around me for a number of years knows that I'll spout this stuff off all day long, but there's so many good deductions. There's depreciation. Whoops. Use a color you guys could see might help. There's depreciation against your real estate, which is a fancy way of saying taking a deduction. There's cost segregation, which is we can accelerate that deduction into 1 year, depending on the year that you bought that property. If you bought it, like we could still do this, by the way, for properties that you bought last year, the year before, as long as we make a cost segregation election, we could make it for 2022. We could literally lower your taxes for 2022. And some of you guys are saying, but I already filed. Doesn't matter. We can go all the way up until the deadline plus extensions. So that's actually for individuals, that's October 15th. For businesses, for the most part, it's going to be September 15th, but we could still do that. And I'll go over what cost seg is again in greater detail. There's real estate professional status. We do go over dealer versus investor, which is really important because this is a trader business. This is not. Investors are not. They're treated under different rules. Airbnb, by the way, is a trader business. It's not, if it's 7 days or less, average stay, it's not real estate. It's considered transient housing. It's a hotel. It's an active trader business, which means you can get mass losses out of that. That'll offset your W-2 income. There's so many little things, like our meals are 50% deductible. We could write off 100% of our travel. There's deductions for cars. It's 65.5 cents a mile right now. If you just reimburse yourself, if all you do is get Mile IQ, which is an app you get on your phone, and you just put that Mile IQ, it'll GPS track you, and you start saying, especially if you get an administrative office in your house, anytime you're doing anything business-wise, you write yourself a check for 65.5 cents a mile, and it's deductible. You don't even have to show it on your 1040 return. You just get to take it. 280A we're going to go over, which is a fancy way of saying free money. It's it's the 14-day rule for your home, where you rent your house out for 14 days or less, and you don't have to recognize it as income. You don't have to pay tax on it, and you rent it to your own business. So if you rent to your business, whether it be an S Corp, C Corp, or an LLC tax as an S Corp, or an LLC tax as a C Corp, even a 501c3, if you want to rent to your own business, you get that money tax free. Cell phones are a big one. I don't know why people still try to do this weird cell phone thing on as sole proprietors. They get audited, and I'll show you the rates. They lose 94 to 95% of the time. Sole proprietors do in their audits. They just get rooked, right? It's crazy. The administrative office, I'll show you how to get, it's about, I don't know, 10 times as much as the home office. If you do it the legacy way, which is when you're a sole proprietor. If we actually have a corporation, again, an S Corp, C Corp, 501c3, there's so many cool benefits. There's things like using a 501c3. If you're into doing things that benefit society, then you could literally decide to do it in a tax exempt entity. A lot of people don't realize this, but IKEA, the furniture folks, right? That's a charity. Harvard NFL was a charity. They took it private. One of our attorneys actually worked on that transaction. The Green Bay Packers are a charity. Just about every school is a charity. Just about every hospital is a charity, right? They're exempt. They don't pay taxes. So there's a possibility, depending on what you're doing, that sometimes you could take what you're doing and put it into a tax exempt realm, including in real estate. And in real estate, if you're helping veterans, if you're helping our older folks, if you're doing low to moderate income housing like Section 8 housing, that actually qualifies. So you could choose to do it under in a way that is tax-free and tax exempt. 7702 plans, that's a index universal life or cash value life insurance where the cash value grows tax-free. We like that. What are some really cool ones? Clint was talking, I heard him this morning talking about the $66,000 Roth, which is actually very easy to do when you have a 401k. You have contribution limits in IRAs. You do not have contribution limits for the Roths in a 401k, meaning that you can get up to the limit, the overall limit of a 401k, even on a Roth. And what you're doing is you're over contributing to the employee deferral portion. You're writing it a check, and then you're rolling that during the tax year into the Roth bucket, and that's all it is. And it saves you a ton of, like, you're going to have a ton of money sitting in your Roth. So if you want to do things, defined benefit plans, I talked to you a little bit earlier. We can put a ton of money in a defined benefit plan. And by the way, if you're making millions of dollars, this guy right here, Captive Insurance, can save you up to $2.4 million a year, putting it in a vehicle that will not only give you a tax deduction for this year, but it'll grow in its own environment as a corporate entity, as an insurance company. It's actually legitimately an insurance company that you're making to self-insure your business. And when you're all done with it, when you finally close it down, it's treated as long-term capital gains. So it's a way of kicking a tax bill way into the future. You could do that. So I have clients that do those. They're putting $1 million plus a year tax deductible into those types of plans. And I'm just saying is that there's a lot of options. Accountable plan we'll talk about, S Corp versus sole prop we'll talk about. HSAs, this is a triple threat. And I'm just going to write HSA equals triple threat. Why? Because you get a deduction. This is a health savings account, by the way. You can put in a health savings account. It is, what is it this year? I think it's 70. Where's my HSA? Oh, shoot. I'm trying to remember. I think it's $7,300 a year that you can put in that HSA. I should know that off the top of my head, but it gets clogged in there with other numbers. But that HSA, some of you guys may know, you could put over $7,000 a year and take a tax deduction. The growth is tax-free. It never gets taxed. And if you use it on health expenses, you'll never pay tax, period. It's the only thing I know of where you get a tax deduction and you don't have to recognize taxes ever again. So it's pretty amazing. So there's a whole bunch of this type of information that we have access to. There's this little guy that freaks people out. C Corps aren't subject to the hobby loss rules that trips people out. So if we're going to make losses because you're doing a business that is borderline, it's like, okay, I'm trying to make a profit, but the IRS may not like it, may disallow some of my deductions. We don't have to worry about it if it's a C Corp. So there's a lot of stuff out there that we go into. The question for you is, do you like this type of information? Because I'm going to dive in, and depending on your answers, will determine how deep I go this afternoon. If you like this type of information, then I will give you a whole bunch of, okay, so you guys love it. Good. So, okay, then we're going to go some deeper. All right, this will be fun. Questions you might ask. Now that remember I asked you how you feel about taxes. Now I want to know how you feel about taxes. And this is the questions you might be asking yourself. Hey, Toby, do I have to change what I'm doing now? What do I have to do? Right? Or you might say, do I need other types of investments? Do I have to do something else than what I'm doing? That's why we're talking. We'll be able to figure that out. A lot of you guys might be surprised. You may be able to do this with exactly what you're doing. And the big one for me is always, do you increase your risk of audits? Because you do a tax plan, last thing you want to do is have to keep jumping into it. Somebody says, can you talk about a 1031? We'll talk about a 1031 a little bit. I'm also going to give you guys a really good example of the value of tax planning, because it's not just taxes that it helps. You're going to see that some of this stuff has a dramatic impact on even things like your, let me see if I can make this go away. Even things like your credit. It's kind of weird, but it literally will do it. All right, this guy does not want to go away. I'll figure it out later. All right, so I use this as kind of my pain meter. This is how aggressive do I want to be in my tax planning? And farther I get over here, I'm going up to a 50% tax rate, the more pain I get. This is the harder I will work. So this is where you go hard. Like if you're down here and you're not really you don't really have much tax, you're going to do kind of easy strategies. You don't have to go nuts. But I look at something called a sweet spot. My sweet spot, and you guys might say, this is weird coming from a tax guy, but I'm okay paying up to 20%. If my overall tax amount that I pay, because the more you make, the more they take. So your taxes go like this, right? The more you make, the higher the percentages that they take. So that percentage goes up. You go up to 37%. You start at 0, right? So you go to 0 to 37% because you're making too much money. But I'm just looking at this going, hey, if I could have a world where they just said guaranteed 20%, quit messing around, I'd be going for it, right? Because the more you get into the higher transactions and things like that, I hate the nasty surprises, and I hate especially the active income. I feel bad for doctors because they make a whole bunch of money and everybody's like, oh, but they're paying it. Some cases, 50% of their dollars that they make over a certain amount is going to the government. That's really frustrating. The trick for you is, what is your sweet spot, right? And how hard are you going to work? Because if your sweet spot's in here, then you're going to want to work hard probably around in here, right? This is where you start implementing more advanced strategies. You might be looking like saying, I'm never going to get above 30. I am right here. Like I don't, if I can keep myself maxed out at 20, I'm good, which means I'm targeting probably down in here to make sure that I never get up to 20, right? That's what we want to do. We want to be looking at our various options. And I have a real simple underlying principle. I told you guys that I would tell you my philosophy when you guys were talking about your why. This is my philosophy. All those whys that you gave was that you're a better steward of your money than the government is. And I honestly believe that. So I would and that's because I've been doing this for so long, and clients are really cool. Like when I was talking about that, my buddy's mom, there was a bunch of people saying you should do that. It's not an accolade, but they're like, that's the right thing to do. Yes, it is the right thing to do. And we want to be in a position to help people. Andrew Carnegie, the wealthiest man in the world at one point, he said, millionaires are trustees of the poor. There's some people that can't make money. There's some people that, because of circumstances beyond their control, are not able to. They're infirmed or their life situation. And then there's some people that are really good at making money. And the whole idea is, hey, if we're going to make society work, the people that are really good at making money, you should be decent to other folks. And here's what I see. Most people are. People are really generous. If you watch the news, you'd think people are horrible. Not my experience. My experience is that most of you guys, if you had extra money, you'd be thinking of some cool things that you could do for other people and how you could help your family. You're not thinking of, hey, I'm just going to do things just for me. Maybe there's a couple of you guys, but for the most part, what I see completely is that if only we had more people that were making more money and we're in that position, that we wouldn't need as much government. And by the way, in the housing world, we're a good 5 million to 7 million units underbuilt. So we need to make sure that we're doing something for these folks. And if BlackRock buys up all the houses, they can't be human beings. They have to benefit their shareholders. They have a fiduciary duty to their shareholders. They don't care about the tenants. When I say they don't care, like they care, like maybe, but their duty is to their shareholders. We need individuals like us owning houses that can actually act like human beings, right? But they may not have a choice. They might have to do. So if you have a veteran or somebody that suffered or somebody that's a widow or something that, hey, I could actually do something for, you can be in that situation. And I'm not saying you have to. Some of you guys say, yeah, that's not for me. I want to benefit myself. God bless you too. But I just happen to believe that if I could save you guys money, and I'll do everything I can to make sure that you guys have the information, so you put more in your back pockets than going to Uncle Sam's, that I just know that good things will come out of it. It makes me feel good. All right, let's talk about avoiding audits and saving on taxes. We're going to jump through a lot of this because I want to burn through and get to the tax deduction because you guys want to go deeper. I want to honor that. I want you guys to know that tax audits, it's a red herring. There's very, very few. That's the number right there, that below a fraction of a percent that are face-to-face audits. Most audits are correspondence where they're checking on a number, and the IRS is completely undermanned. It's bad. Like when Congress is trying to give them more money and they keep talking about all these agents, I'm like, the IRS uses a program, COBOL, from the 80s. Just upgrade their system and get us some human beings there so they can answer their phone. Because about, like, I think they answer 1 out of 16 calls right now. It's really, really bad. During COVID, they all went home. They actually took envelopes that were mailed in, like returns, and they took the checks out of them, and then they put them in a truck, and they stored them, and they just sat them there for months and months and months. So then the computer system just starts shooting out, we're going to levy on your house. And you're like, but I can see you negotiated the check. And the agents are like, yeah, there's nobody in the office, we're not going to do anything. But you're like, thanks. Clients are chewing our ears off, right? And it's like, they're just undermanned, severely undermanned, and it's not going away anytime soon. This is the audit rates for, this is 1 to 100,000, just so you see it's consistent. This is the audit rates for 100,000 to 1 million. And this is 1 million and above. The audit rates have died. This is 2012 to 2020. They're just on a downward trajectory. When you look at these things, number of returns examined, just look at this. This is the IRS. This is publication 55. You can look it up every year. They publish their information. Look how many actual field audits there are. There's just very few. It's all correspondence. It's computer driven because they don't have personnel. Now, you know who they like to audit? I'm going to ask you guys a question. Who does the IRS audit the most? If you was a category of people, and I'm not talking about race, if you just said category of people, who do they audit the most? Who do you think it is? Rich, poor, middle, investors, business owners, businesses? Who do they audit the most? A lot of you guys are saying middle class. A lot of small business owners, nope. They almost never audit the business owner unless you're a sole proprietor. They audit the lowest wage earners at a rate of 12.7 to 2. It's ridiculous. They audit the poor because the poor doesn't fight. You audit somebody who has money, they're going to fight you. And if you have a structure, you have the law on your side because that Internal Revenue Code is written for you. If you miss something, there's chances are there's something else there that you still get you to Z, A to Z, right? This is the millionaires being audited. Take a look at that. 7,710 were audited last year. Right, when I show you the numbers, it'll freak you out. So this comes out of the IRS data book. You can actually see who pays revenue. This is the total revenue up here. That's total. But this is individuals. They pay all the taxes. This is self-employment tax. This is gift tax, estate tax, which are really small. What this really is Social Security. So I'm just going to put FICA down here. That number, by the way, in some years is higher than the individual income tax. This year, because of COVID, they had all these reductions. They had credits, and they had bunch of fun stuff that lowered it. But normally, like the year before last, employment taxes were higher collection than individual income taxes. So if anybody ever says that the poor don't pay tax, I just point to it like they're the ones paying the employment taxes, my friend, because they phase out after about $167,000, like for the vast majority. Like the Medicare goes on at 2.9%, but 12.4% is old age, disability, and survivors. Is Social Security. And that phases out. So by definition, the people paying the most taxes in this country technically are the people working, and it's not all the rich. But if you look at who pays the taxes, business tax 9.7%, individual income taxes are 59% of the revenue, employment taxes are 28%. But like I said, that employment tax number is usually 45 and 45, like they're really close. they're almost identical. But again, I'm using the numbers that they give us, so I'm not going to sway it. And then I could just look and see, hey, who gets audited? Well, they actually give us the rates. So I can actually pull up stuff and I can actually see with my own eyes, no positive income, 0.3. So the average is 0.2. So that's our litmus test, right? Under 25,000, 0.4. You are at the average when you're at 50,000, 25,000 to 50,000. Everything else on up to 200,000 is 0.1. The middle class doesn't get audited. Then you get up and you get over that $200,000 line and you start getting up into 0.2, which is the average, 0.4 over $500,000. So if you don't want to get audited, make sure you just don't make over $500,000 of taxable income. It's still not horrible. And then here, let me show you what businesses pay. Oh, look, partnerships and corporations. Why do they have like a funny little 9 there? Oh, that's right. It's because it's statistically insignificant. It's 0.05% or lower. All that means is that the S corps and the partnerships almost never get audited. Some people might say, why is that? Well, it's because they're businesses. Like, what are you they're just going to write everything off anyway. Now, if I look at businesses that are sole proprietorships, it's another story. Like, here we go. If you're making between $100,000 and $200,000 as a sole proprietor, your audit rate is 1.6%. Remember, the litmus test was 0.2, 1.6. So it's only 800% higher. Percentage of returns examined with no change, which means hey, I looked at you and you were good. 5% and 6%, which means, let's turn that around. How many returns got changed during that audit? 95 and 94. If I looked at a S corp, the last full time I have all that data. By the way, this chart was discontinued by the IRS. There's a little, so the last year I have this data is 2019, though it's been the same data year after year. Actually, these dropped a little bit in 2019, but for the most part, it was always 2.2, 2.4% up here. And then the audit rate on S corp is usually 0.1 to 0.2. And there you go. And then you could see much higher degree of likelihood that no change is going to take place. It's significantly different. Why does that matter? Because when I'm setting up a business, I can go where they don't audit. That's why we use partnerships, S corps, and C corps. They just don't get audited very often. Let's talk about types of income and how they're taxed. This will help us make really good decisions. Number one is earned income, and it's taxed at your ordinary rates, which is 0 to 37%, plus FICA, Social Security, self-employment tax, whatever you want to call it. And this one is, what is it? 12.4 and 2.9, so 15.3% with a little bit of a phase out. So you can see when you earn income, ouch, they really hit you, plus your state income tax if you have it. Portfolio income is comprised of multiple types. You have royalties, interest, dividends, and capital gains. Royalties are taxed at ordinary only. Interest is ordinary only. In other words, we lose our FICA, we lose those employment taxes that hit us. Dividends, get this, if it's qualified dividends from a U.S. company, it's taxed as long-term capital gains, which is 0, 15, or 20%. Capital gains are either long-term when they're greater than a year, so you held an asset in, for the most part, there's a couple of exceptions like in futures, but it might be greater than 1 year. If it's short-term capital gains, like if you're selling options on your securities and you're doing that, you're not doing leaps, you're looking at 0 to 37%. So it's ordinary again. The important thing to know about capital gains is that capital losses, so if you lose money in the market, only offset capital gains. So if I lose money in the stock market, I can only use that against my capital, my other capital income. And that's why you get these large capital loss carries forwards. There's one exception, which is $3,000 a year you can write off against your other income. That's why when the market drops and people sell, and you see these people that are like, holy crud, I ended up with these huge capital losses and I can't use them. Yeah, you had gained the previous year, you sell it and you lose, especially people that do mark-to-market elections. Those people are crazy in my book. You see traders doing that all the time, and they just nuke themselves because they didn't have to sell. They have to recognize the tax as though they did sell, and then they lose money. You have to recognize the gain, and you can't offset it with this big loss, and you carry that loss forward. But there is a restriction on the ability to take losses for capital losses. Then there's passive income. There's two types: rents or businesses. In those businesses is no material participation. And these are all ordinary, and they're passive. And the reason this is really important is because passive losses offset passive income. You can't use passive losses against other income sources unless you fall into one of two categories, and that is a active participant in real estate, and you make less than, so it's let's see, you make less than $100,000 a year. It phases out between 100 and 150,000. So if you make 110,000, you still get a partial, but it's limited to $25,000. So you get a $25,000 amount. In the second one, I'm going to put the second one over here, and that is real estate professional. When you're a real estate professional, your losses become ordinary losses. Now, I will say this, people ask this all the time. What happens if I have losses that carry forward, passive losses? So I did a syndication or something, and then it sells. When you sell substantially all of a passive activity, those losses are no longer passive. They become ordinary. And so you can use it and offset not just your passive income, but also you can use it to offset things like your W-2 income, royalty income, interest income, portfolio income, any other income, you can use it. Somebody says, you might have to adjust your view settings. If it's going off the screen, I apologize about that. It's the view settings that are being used by the recipient. Let me just see if I could pop that up. So I'll try to make it a little bit bigger. Maybe you can see it there. But I really want you to hear my words more than just read, because all of that, everything I'm telling you is in that tax toolbox. And if you want, it's also more than likely you'll find plenty of videos that go over it on the YouTube channel as well. But I want you to actually kind of digest it for a second. So there's multiple types of income. I'm looking at three main ones, and they're treated differently from a tax perspective. The two that we have to worry about where could be losses is when we're investing, and that's capital losses and passive losses. Passive losses are rental real estate and also businesses in which we do not materially participate. What is an example of a business that I don't materially participate in? It's like if I'm a silent owner in a pizza shop. So my nutty uncle, and I give him a bunch of money and say, let's go open a pizza shop. And he says, great. And he loves pizza, but I don't want to work in the pizza shop. And that thing makes $100,000 and we're 50-50. His portion is subject to self-employment tax because he materially participated. It's just regular old earned income. My portion is passive. So if I have other passive losses, like from real estate, guess what? I don't have to pay tax on that 50 grand. That's why rich people, you always see Robert Kiyosaki talking about how they invest based off of their tax, their tax appetite. So they're looking and saying, hey, I have a bunch of other income, I need to offset it. So if I have a whole bunch of passive losses, I may be looking around at businesses that, hey, I could invest in that might create some cash. Why? Because I get it tax free. That's a great thing for me to do. I was like, hey, I want some free, I want some free money. I'll take that action. This is, by the way, what it looks like. I'm going to go to 2023 just so that I'm not boring you guys. When I look at the tax rates, this is ordinary. The more you make, the more they take, right? You go into these higher brackets, it's not retroactive. It's only when it gets over a certain dollar amount. So for example, if you are single and you make more than 578,000, the amount over that is what gets taxed at 37%. Also, your long-term capital gains are following a similar path. If you are married filing jointly and you make less than $89,250, any of your capital gains or long-term capital gains are taxed at 0. Your short-term capital gains are still taxed up here, right? If you're making less than 90 grand, you're in the 22% category, right? Or excuse me, if you're a single, that would be the case. But if you were married filing jointly, you're right here, you're in the 12%. So it's not catastrophic, right? Oh, I got some short-term capital gains, 12%, right? Still not too worried, but you get that 0. And then you have a huge bracket. Just think about that. For married, you're up to 553,000, where it's in the 15% category. For single, it's up to 492,000. These are awesome. This 20% is really 23.8. There's this thing called the net investment income tax. So on these types of income, they throw a zinger in. And so I actually have these little cheat sheets that I make. I steal them from Financial Samurai, and then I put my own notes on them. But it kind of tells you, hey, depending on where I am, so like this is singles, I can see once I get into this range, I'm like, okay, I'm starting to feel it. I'm starting to feel it. It's getting a little high. We're over the 20%. That's when I know I kind of want to cap myself right around that 100,000 mark. And for married filing jointly, I'm kind of looking in here. I'm saying like, hey, I'm really feeling it. I'm not enjoying this. I'm not enjoying this at all. I really want to get down into about right here. 200,000 would be kind of my target number. If I get underneath 200,000, I'm not crying. I'm okay with it. Now, why is this so important? Because as Clint said, certain activities are taxed as ordinary income, are taxed as businesses. So wholesalers, for example, it's earned income. You're going to be subject to ordinary income brackets and Social Security taxes if you do that in your name. And so there's one entity that kills the employment taxes, and that's called an S Corp. It knocks it out. Or if you don't need money, you could do a C Corp. If I need the money, more than likely I'm being an S Corp. Like if you're a real estate agent, same thing. It's earned income. But the strategy for you is almost always going to be some sort of S Corp. And if you're a real estate agent and you say, but my state doesn't allow it, there's a way to do it from a tax standpoint, even with your state requiring that they pay you individually. I can show you how to push that over and get it into an S Corp to avoid the payment of employment taxes. And let me just explain how that works real quick. The payment of employment taxes are done on the money that you take out that's active. So as long as I pay myself a salary, there's employment taxes. Everything else that comes out of that S Corp, so let's say I make $200,000 and I pay myself a $50,000 salary. 50 of it is subject to employment taxes. 150 flows out to me as not subject to employment taxes. And remember, those employment taxes are 15.3%. There's a slight deduction for it, makes the math closer to 14.1, but it's still a big chunk of money. And this is the way that we avoid it. I'm going to show you guys a couple more things here. I'm going to change my ink so I can read this. Construction is also earned if you're doing construction. And again, you already know what the strategy is. It's really that easy. It's an S Corp or a C Corp. And with all of these, it could be an LLC taxed as, right? LLCs don't exist to the Internal Revenue Service. They say, tell me how to treat it from a tax standpoint, because there's no LLC tax form. you're going to use either a partnership, an S corp, a C corp return, or it's going to go on to the owner's tax bracket, and it's going to be ignored. We call that disregarded. A dealer, somebody who buys property and sells it, and it doesn't matter how long they hold it. If I hear another person come up to me and say, well, I held it over a year, so I'm not a dealer. That is not true. The seminal cases on point that the IRS uses were 10-year holds. A dealer is somebody who buys property with the intent to sell it, and they are taxed as earned income. And they cannot do, there are no installment sales, and there's no 1031s. Now, an installment sale is when you spread out the income over more than 1 year. So when you do installment sales, you end up spreading the tax hit over many, many, many years. And a 1031 is when you just want to avoid the tax and you roll it into another bunch of properties. You cannot do either with a dealer. Short-term rentals, this is your Airbnb. And this is equal to the pizza business. This is a trader business. If it's 7 days or less average stay. And the way you figure that is how many days or how many days did we rent the unit out divided by how many rentals you had. So if you had 20 rentals and you rented it out 100 times, 100 by 20 is 5 days, you're an Airbnb. And with this, the loss equals ordinary. It's not passive. This trips people out. So if you're a doctor, dentist, high-paid consultant, salesperson, just a high-paid employee, a C-level, whatever, and you want a deduction, this is where you get there. What you're going to do is you're going to buy a property every year, preferably in the last quarter. You're going to make it a short-term rental. You're going to accelerate the depreciation. You're going to write it off, and you're going to offset your W-2 income and pay very little tax. Long-term rentals, tax treatment is passive. Isn't that wild? We just went through all this real estate stuff, and everybody thinks everything's passive in real estate. There's only one, and the strategy there is you're holding, and it's usually a 1065, which is equal to a partnership. It's exactly what Clint was showing you with the blue box. That's the strategy. I'm going to give you one example, and then I'm going to give you a 5-minute break. I want to show you guys exactly how this works. So I'm going to give you an example of a client, Mike and Sally. Mike and Sally lived up in Washington, and they were netting as ICs $200,000 a year. It was only Mike that was working, but he was netting that. So he was an IC with Microsoft because Microsoft loves to have independent contractors. What does that mean in English? He was a sole proprietor. Because he was doing projects for them, he would get paid about every 90 days. So he maintained a $70,000 credit card. And the reason this is important is because he was averaging 11% on that credit card. But he had to keep and pay all of his vendors so that he could get the projects done. And then he always had about a 90-day wait where they were paying him. So he always had his credit card full. So he had 2 credit cards. They were about $70,000. He also had a mortgage on his home. It was a $700,000 home, but he had about a $500,000 mortgage. And this will all make sense when I go over it. The mortgage was right at around 6%. It wasn't now. This was actually when mortgages were a lot lower. So it was kind of like that was a bad mortgage rate. And I'm just going to say his FICA was about a 670, if I recall correctly. All right. He and his wife had IRAs from previous employers. Wife had 130,000 and he had 70,000. So you guys are getting pretty good at this stuff, right? You guys should have kind of an idea of what you have and what we could do. Anybody have any ideas of what we could do? What would be your first step? What's low-lying fruit that we could do immediately to save Mike a bunch of money? And let's just think about this real quick. Mike because of the amount of income he's making, he's paying about $40,000 a year in income taxes. Plus, he had employment taxes in the $24,500 range. We can do the math here. He had 11%, so he was paying $7,700 expenses. I'll just circle the expenses. His mortgage, he was paying, that looks like it's about $30,000 a year. This is what we're working with, right? So he's got some expenses. He's not, when I add that stuff up, that's not pretty. I don't like that. I don't like how much he's paying. He's paying 64.5 plus 7,700. He's got to be, that's got to be around 100 grand. So I'm just going to, I know it's a little bit more than 100 grand, but I'm just going to call it 100 grand. That stinks. That's not good, right? You guys are probably looking at it going, man, that really does stink. Get out of the sole proprietorship. Yeah, somebody's saying that. But yeah, what we do is, first step is we create an S corp, because we know that we can eliminate a good chunk of that self-employment tax. So step one, I'll just say, let's set up an S corp, and let's have his $200,000 made in an S corp. We'll also attach to it a 401k, and I'll show you why. Step two is a 401k. And the reason we do the 401k is really simple. If we could do the 401k, we can roll this guy right into it. So we can put $200,000 into that 401k. And in a 401k, you can borrow up to 50% per participant. So if you need money, in this particular case, they just borrow the $70,000 and pay off the credit card. So we have both now. In the S corp, we'll take a $60,000 salary, because we have to take something out active, and that's the only thing that'll be subject to the employment taxes. So our employment taxes are going to go down considerably. So if we do that, we should save net about $16,000 a year just in the employment taxes. And that's not a misquote. There's a phase out at 167,000. So he was paying employment taxes, which the math is 14.1% on $200,000 with a partial phase out. So like he was getting hit hard on those employment taxes. Was not good. He was also paying the $7,700 on that credit card debt, so we can take that away. And then here's the most interesting part. When we do this, there's something else we could do. We could also make contributions of 20, what is it this year? It's 22,000 if he's under 50, 22,500 employee contribution. It was slightly lower than that when we actually did this, but I'm just going to use today numbers to give an example. So you could do that, plus you could do 25% of whatever his salary was, which is 15,000. So he could put an additional $37,500 tax deferred into his 401k. So we did step one, step two, step three. What would be step three is to pay off the credit card, is to roll IRAs and borrow. And that gives us the ability to pay off the credit card, which saves us $7,700. We can continue to defer a large chunk of money and write that off as well. That would give us, gosh, what would that be? That's about an $8,000. I'll just say $7,000 savings, because it would be about 22% and 21% of 37, whatever that is. I should actually get my calculator out. Let's just call it 21% of 37, which would be, yeah, right, a little over $8,000. So I'm just going to call this $8,000 also being saved. And then the most significant thing that actually occurred was, because he paid off those credit cards, you know what his FICA did? His FICA went up to 730. So he refied. So step four was to refi. And his refi, because it went up to 730, dropped his rate by a little over a point. And I think the savings on it, and I'm using loose numbers, but the savings on that was right around $8,000 also per year. This is just without trying much. It's 2 entities, but I want you guys to see how potent that stuff could be. That's 16,000, that's 32. So it's right around $39,000 of annual savings because he set up an entity. Does that make sense to you guys? Now you guys see how this stuff kind of works. And the punchline was with the S Corp, we actually could get it credit cards that do not report to his FICA because it's a business. And so like American Express will report to, it doesn't report to your FICA. We got him ones that did not report to his FICA. He still personally guarantees them. So you got to pay him back, but it no longer affects his FICA. Isn't that wild? I love stuff like that. So that's it. I'm going to give you guys a 5-minute break, and we're going to come back and go over depreciation and cost seg and accelerated depreciation. Give me an emoji if you like this type of information, because I always think stuff like this. It's the stuff that I never would have thought of. Like I wasn't thinking about his FICA when I was doing the structure with him. I was like, hey, let's get this money out. Let's move this around. Let's make your business more successful. Hey, you're getting killed in taxes. Is there a way I can minimize the hit from having to wait that 90 days? And that's what we did. And it ended up putting a lot of extra money in his pocket, cut his bills significantly, allowed him to grow. This was several years ago. And he was like, we're just killing it. We're just killing it. Absolutely. Because now he could grow faster and he's not being hamstringed by all this fun stuff. All right. So let's take 5 minutes and we'll come back and we'll finish this thing up.
Preserve your real estate investment earnings. Protect your assets for future generations. Prosper with the help of a dedicated team of lawyers and tax professionals to make your investments work for you. Anderson Advisors has been providing convenient, world-class service for over 25 years. We are committed to teaching new and veteran investors how to earn and keep the highest returns from their real estate portfolios. Whether assisting with initial business registration paperwork, property acquisition, or advice on tax reductions, Anderson Advisors provides guidance to investors to take charge of their businesses and ensure success. Anderson Advisors, experience you can trust.
All right, let's dive in. Real estate taxation. I'm just going to say that when we're talking about real estate taxation, there's some benefits here. I'm just going to kind of write them down for you because some of you guys have been asking, hey, what's this one? What's this one? I look at it and you have the installment method, which is section 453. Where you're recognizing income over a period of years. So if I do an installment sale to somebody, for example, if I had a property, it's gone up in value and I'm like, geez, I really don't know if I want to sell because I don't want to have a big tax hit. But that person says, hey, will you spread it out over 5 years or 10 years, whatever it is? Then I would recognize the return of my basis tax-free. I'd recognize, I'd have to recognize my recapture in the year that I did it, and I would have my capital gain that I'm recognizing over that period of years, whether it be 5, 10 years. And then I would have interest that I'd have to charge them that I'm recognizing as I receive it as well. The interest, fair market interest, if it's somebody that you are that you're related to, or that you're worried that you're not going to be charging a high enough amount, go to the federal AFR rates. They're right around 4% right now. And that's a related party transaction. You can use that and know that that's a great number to use. But you're doing it as an installment sale, so you're recognizing it over a period of years. If you don't want to pay the tax at all, you do what's called a 1031 exchange, which is section 1031. In a 1031 exchange, the most common one is a Starker exchange, where you sell a property and you have to buy a replacement property or properties. So I could sell a property and buy 10 properties as a replacement. I could sell a single family and buy 10 condos, or I could buy 2 condos and a self-storage and a duplex or whatever. As long as I'm spending the amount of money or more, and I'm not getting a bunch of cash out of the deal called boot, like debt, the debt gets extinguished, then I'm okay. So as long as I'm buying something, unless I'm putting cash into the deal, I have to be buying equivalent property from a price standpoint. So if I sell it for $1 million, I got to buy $1 million of property. If I buy $500,000, then I'm going to have $500,000 of gain and recapture and return of basis that I'm going to have to contend with. So you use a 1031 exchange, qualified intermediary. They're fantastic. They'll usually know, but all this means is I can buy more property. I could diversify my property. Let's say that I'm big into single families and I'm like, you know what, Toby, that's not a good idea. Let me sell some of my single families and go buy some storage because I don't want to fix toilets anymore. And I don't like tenants. Or maybe I go another route and I'm like, you know what, I've been watching Monopoly a lot. I've been playing Monopoly. I'm going to trade in some of my greenhouses for a red hotel, right? I could actually do that. I could actually go and, like, say I buy an apartment complex. So I sell 10 rentals and buy an apartment complex. I can do that with a 1031 exchange and pay no tax. The basis of the old property comes on in there. I could also do a reverse exchange where I buy a property through a qualified intermediary and then sell a property. So there's a lot of things. There's little rules like I have to identify replacement properties within 45 days. And it comes down to how many you identify, and it can be a percentage of the actual sale amount. There's all these little nuances. I don't want to get into that today. I just want you to know that if you don't want to pay tax on the sale of property, you can do 1031 exchanges. If you want to do cost seg, this is a huge benefit. And I'm going to go over this in a little bit, but I'm just going to say a cost segregation at its core is this. Like, I am sitting in a studio right now. It's my home, and there's carpet on the floor. There's fixtures. There's stuff on the walls. There's things that can be removed. All of that is not 27.5-year property. Like, my carpet's not going to make it 27.5 years. Better yet, let's visualize we're walking into a rental property. So let's picture your favorite rental property. If you don't own rental properties, just think of a little cottage. But think of yourself walking through your rental property. You're walking up and you just redid all the shrubbery in the front. Maybe you painted it and you put new carpet in. You put some new linoleum in the kitchen. You replace some of the appliances. Maybe you fix the deck out back and you put some trees in. Somebody like me that walks through there says 15-year property, 5-year property, 7-year property. All these things have a useful life a lot less than 27.5 years. And when you cost seg, all you're doing it, that's the way you're supposed to do it, is you're writing things off over their useful life the way that the IRS asked us to. If you don't want to do a cost seg, then you do it over 27.5 years. Otherwise, I could write those things off over 5 years, 7 years, 15 years. And then there's something called bonus depreciation. And what you do with bonus is anything 20 years or less, I can write off. In this year, it's 80% immediately. But if that property was bought in 2017, 18, 19, 20, or 21, it would be 100%. So 20 years or less useful life, I can write off almost immediately. So if I have property that I bought last year, for example, and you're in that boat, and I want to take a big bonus depreciation, I'll show you an actual report and you can actually see what it looks like. You could actually accelerate that depreciation and say, hey, you know what? I want a big loss. And I can usually write off about 1/3 of the value of a house. So like, let's say I bought a duplex for $400,000. I'm probably looking at about let's say the land value is 20%. So 320 and probably 30 to 40%. So you're probably around $120,000 deduction in year one, even though maybe I just put a small down payment, and that money may actually save you enough to cover the down payment. Sometimes it does. It's kind of freaky. And then it gets even weirder when we do things like mobile home parks and things where there's lots of land improvement. That's about 90% of the value. We could write off about 90% of the value on some of these things in year one. It's insane. RV parks, same thing. If you do car washes, same thing. Bonkers, absolutely nuts that you get these huge, massive deductions. It's passive loss, but if you have an appetite for passive losses, this is easy peasy for you. Otherwise, you're just going to carry that. You're just going to carry that loss forward, and you're not going to pay any tax on your rents. So let's say that I write this off, get $100,000 tax write-off, and I'm netting after all my expenses. I end up netting $10,000 a year. I get $20,000 a year every year, but I'm netting. What I actually have to pay tax on is about 10. That bonus depreciation just wiped that out for 10 years. I'm not going to pay any tax for 10 years on that. And if you get to the point where it starts to become taxable, all you have to do is buy more real estate. That's why the joke in real estate accounting has always been, if you're paying taxes as a real estate investor, it's because you don't own enough real estate. And then you get something called a step up in basis. Step up in basis is when you pass away, all capital assets step up to their fair market value. So your family will never pay tax on it. They can actually redepreciate it. So get this, I own property. I depreciate it during my lifetime. I never pay tax. I die. My family gets that property. Let's say it's my daughter. she redepreciates that property again. So she's again not going to pay tax on any of that again. She could borrow against it. She could do the exact same thing. Isn't that crazy? And then the last one is qualified opportunity zones. That's a red herring, in my opinion. I don't really do too much with the qualified opportunity zones, but they're a deferral. If you don't want to pay tax, you can actually defer until 2026. And if you invest in a qualified, it means you defer the capital gains. You're still going to pay tax on it, but you wait, what would that be, 3 years? And then if you invest in a qualified opportunity zone and you wait 10 years, you don't have to pay tax. The basis steps up to the fair market value on year 10, and then you could sell it and not pay any tax. All right. So those are kind of the big things that people look at in real estate and why people invest in real estate. But I wanted to get really down and dirty on the depreciation and the cost segregation. So I'm going to dive right into it. The big mistakes I see accountants make day in and day out is that they don't depreciate 5, 7, and 15-year property under the Tax Cut and Jobs Act on real estate. I don't know why they don't, but they don't. And then CPAs like to never group activities. I don't know why they do this, and it prevents people from qualifying as real estate professionals. Or let's say that you're self-renting. So let's say you're a doctor and you bought your office and you're leasing to yourself. You can group those two activities so that real estate loss is no longer passive and will offset your other income. Or if it's not a doctor, it could be a mini mart. There's actually cases on that where they rented some of the upstairs units, but the downstairs was a supermarket, and they grouped the two activities and wrote them off against each other. And then the last one is the wrong entity. There's 70% of the small businesses out there are still set up as sole proprietors, usually at the urging of a CPA. And I always want to reach out and go, stop that, right? It's like you're not doing anybody any favors. You're exposing them 100% to unfettered liability that could follow them around the rest of their life. How do I know? Because I clerked for 3 different judges. I sat there. I also chased after a gal who damaged one of my buddy's properties for 11 years and garnished her paycheck every month for years and years and years and years because she purposely destroyed his property. That stuff doesn't go away. Somebody can get a judgment against you and just keep following you around until you go bankrupt or until you pay it. So I will go over what the dollars and cents on the wrong entity from a tax standpoint, but on an asset protection standpoint, it absolutely drives me batty. So let's talk about the basics. If I have gross rental income, so whatever I brought in, let's say that I brought in $30,000, then I get to take a whole bunch of deductible expenses. So I get my travel. So I get my car. So that's 65.5 cents. So you're using Mile IQ and you're doing that type of thing. My cell phone. If you're using your kids, you get to take their in, like, hey, whatever I paid my kids out, get them. There's court cases, by the way, of children being paid Screen Actors Guild's rates at the age of 9. If your kid can do something, it doesn't matter whether they're 16 or not, as long as they can do something, I suggest that you get them doing technology, because kids are way better than us at technology for sure. Internet, you're going to have we have internet, pretend that says internet. This is professional fees. There's all sorts of deductions that we're looking at. What else do we have? Management fees. I know those are out there. Fees. What else we got? You could actually do a administrative office or a home office, either one. I'm going to do it at administrative office if I have to twist your arm, because you get so much more deduction. But if all you have is one entity and it's disregarded or it's a partnership, you might have to do the home office, because you have to have an employer. It has to be a corporation if you're going to do the administrative office. Supplies, obviously, things that you have to buy. Your property taxes. So I'm just going to say property taxes are deductible. You have things like insurance. You get the idea. We have utilities. I'm looking for everything I can write off against those properties. That's your deductible expenses. And then you get to net income. In most cases, this is going to be about $15,000. Sometimes it's a little higher. I think that the average last time I checked was about 65%, but I'm going to use simple math. Made 30, had 15,000, and then I can take depreciation. So I have $15,000 in the bank, and then my depreciation might offset that entire amount and leaving me with zero taxes. That's the idea with real estate. Let me show you an example how this works. So when I'm looking to determine how much depreciation I get, I use either the appraisal or the assessor's valuation. And what I care about is what that ratio is. So the land ratio is a percentage generally. And by the way, on condos, it might be zero. Hey, we're not going to count it. As long as the assessor is giving us that information, I'm allowed to use it. So assume I purchase a house for 500,000, but its assessed value is 300. I'm just using the ratio. I just care about these two numbers. I can use that, or I can use an appraisal. Either methodology works, but my land value is 20% of 500,000, which is $100,000 land. I do not depreciate land. I only depreciate the stuff that the box I built. So purchase price, let's call this a single family residence. So it's people are living in it. I have $100,000 of land, which means my depreciable basis is 400,000. Simple math. I know it's different because it depends on when you buy the house and your accountant does this half yearly stuff and all that. I'm just going to say for illustration purposes, it's 14,500. This is the amount of our depreciation on an annual basis. 14,500. Don't worry, I'm going to put that number back up in a second. So here's our depreciation. And let's say that we get $4,000 a month in rent. So we make $48,000 gross. And then I had $18,000 of expenses. Remember my big list of expenses? And we end up with $30,000. So that's what this is right here. Net operating income, NOI, is 30. Less depreciation of 14,500 means I have taxable income of 15,500. How much cash did I put in my account? 30,000 bucks. How much do I have to show on my tax return? 15,500. Can I do better than that? You bet your Katushi we can do better than that. This is the way that everybody does it. This is the way you do it if you're doing it correctly. And I'll show you why I say that, because it's actually, this is the way you're supposed to do cost save. But your depreciable basis is $400,000, same numbers. Remember, we had taxable income of 15,500. Now, instead of just saying, hey, it's 27.5-year property, we do a cost seg, we would get, and I used a pretty, we would get more than that, but I just used a very conservative number, 100,000 bucks. I still have annual depreciation because all I'm doing is accelerating the depreciation on the 5, 7, and 15-year property. So the rents are still 4,000 a month. My net operating income is still 30, but what I just did is created this big loss of $111,000 because that's the depreciation annually plus my bonus, and that gave me a loss of $81,000. You're going to say, well, what the heck do you do with that loss? You carry it forward and continue to offset your rents, or when I sell that property, that $81,000 gets released and I can use it against my other income if there's no gain in the property. Otherwise, it offsets the gain in the property. So if the property makes 50 grand, I'd not pay any tax on that. Plus, I'd get an extra $31,000 that I could write off. That's how it works. This is what you accelerate, just so you know. You're breaking it into little structures. So here's the 5 and 7 year property is right here. Carpeting, countertops, cabinetry, blinds, lighting, specialty plumbing, wall coverings, removable flooring. This is the 15-year property, parking lots, curbs, gutters, sidewalks, storm drains, irrigation, retaining walls, trees, shrubs, landscaping. That's the one that we always see. And then this is your 27.5 or 39-year property, your structures, your roof, the walls and the doors, the windows, HVAC, plumbing, non-specialty plumbing. Now, here's the secret. When you do a cost seg study, you use somebody who knows what they're doing. You do not go get something on the internet. You do not play this cheap. What we are shooting for, I'll just say, is what's called a 7x return. 7x returns mean when they do the study and they look, like, they don't charge you to do the analysis. If you're one of our clients, we send you right over there, and Cost Seg Authority, they will do a free analysis on your property. What they're figuring out is what portion, in this case, it was 27%, is that 15, 7, and 5 year property. What we care about, in this case, the basis, depreciable basis, was 1.2. Their extra deduction, oh gosh, 9612 and 216. So it looks like 340 some thousand. The tax savings was about 50 grand. I would want to see that cost seg study be less than 7 grand. And they are, in order to get that benefit, because I want to see a 7x return. If I spend $1, I want 7 in my pocket. That's the way I look at it. So there we go. That's what it actually looks like. Let me just see if I can do something else. Boosh. You end up with a nice big fat deduction, and that's what we care about, is you writing the heck off of things and not giving money to the IRS. When you recapture, there's a lot of misunderstanding here. Typically, when you sell a property and you have a taxable event, you're not 1031ing, you have recapture of the depreciation you took. Ordinarily, it's just when you're doing what's called 1250 property. So I didn't do a cost seg, I just have to recapture. It's taxed at your ordinary bracket, capped at 25%. Everybody always says 25%, because if you sell a property that's valuable, it's always 25%. Personal property is its value. If I owned a property 5 years, that 5-year property has zero value, has zero book value. My 15-year property, it really depends on the study and what's being done with that property. It may be zero, it may have some value. That would be taxed at ordinary rates. So all I can give you is what the studies tend to show. So here's a study that was sold in 2020. They bought it in 2015. 2.5, oops. Let me give you a color you can see. 2.5, sold it for a gain of 800,000 plus the recapture. So they held it for 5 years. These folks did not do the cost seg during the time that they owned it. They sold it, and then they heard one of these events and they said, holy kashmoli, are you telling me that I could have done this? And we said, as long as you have access to that property, we can still go back. They paid $285,000 in taxes. When they did the cost seg study, it lowered it to $211,841. So they saved, that was a plus $73,159. Not bad for a free event, right? Because they come in and they're just like, can I do this? Yes, you absolutely can. As long as we get access to the property, we can still do these. Now, this is the form. It's called 3115. When you change, if you've been depreciating your property under the normal, commonly used 27.5 year or 30-year property, and you want to change it to being cost segged, literally, I want you guys to read this. You are changing from an impermissible method to a permissible method when you go from the 27.5 year to the 5, 7, 15, 27.5 year. You're supposed to be cost segging properties, yet accountants always are like, no, this is weird. Why would you do that? It's like, stop it. You're supposed to write things off over their useful life. You wouldn't buy a car and write it off over 27.5 years. Why are you doing it to your carpeting? And then I have to pay tax when I sell the nasty carpet because I have recapture. If I cost seg it as crappy carpet, I don't have to pay tax on it. At least no recapture. It'll be part of my capital gain, right? How far back can you go? There's no limit. What matters is whether because you could cost seg any property, The bonus depreciation depends on the year that it was purchased and put into service. I shouldn't say purchased, the year that it was put into service. So like if you have a house that you lived in and then you made it into a rental, the year that you made it into the rental, those rules that were in place on that year. So if it was 2018, for example, it's 100% bonus depreciation. Even if you make the election in 2022 or 2023, and you still can make the election last year. If up until those returns are due plus their extensions, we can fix it. And that might save a lot of you guys some money. I want you guys to think about this for a second. If you paid taxes on rental income last year, there's a good chance we could get some of that back, even if you've already paid it, unless you don't like refunds, right? Remember what I said, though, I like a 7x return. I want to run the numbers and see if it puts money in my pocket. If it's 7 times the money I spend, I'll usually do it. If you own rentals but have never depreciated, you better start. Michelle, they force you to recapture even if you didn't depreciate. So you may depreciate, you must recapture. All right, so here's the tax reduction technique. And by the way, this is supposed to go till 4. So I'm going to make sure that I bust through this here real quick. You do your cost seg analysis. If it makes sense, you do the cost seg. If this is the first year you own the property, you don't even have to make a cost. You don't have to make a 3115 election. You just treat it the way you should have from the day one. And if you have a loss, you evaluate whether or not we're going to look at being a real estate professional, whether we're an active participant, whether we carry it forward. There's lots of things that we do to look at it. So I just want to hit on that. The last thing I'm going to go over real quick on some of the tax, I'm going to do one deduction that I want you guys to look at. This is, well, that's the tax toolbox. The last thing is the wrong entity. What I want you to look at here, because anytime we're looking at an entity, understand that there's where we file it with the state. There's third parties that we're dealing with, which is the operating agreement and the bylaws. Clint spent a lot of time talking about having an accurate operating agreement. And then there's the feds, how we're going to tax it. You have a choice quite often. Like if you set up an LLC, you could tax it as a partnership. You could tax it as an S corp. You could tax it as a sole proprietor. And what I do is I look at the audit rates of all those. And the lowest audit rate is partnership and S corp returns. Farm returns are really low. Everything else is a multiple. Like in some cases, it's 8 times the level of the audit. And then I look and say, hey, if I do get audited, what are my chances of winning? Crappy when I'm a sole proprietor. Really high when I'm anything else. So I'm always going to be the anything else. Whenever I look at that, I'm like, you got to be kidding me. Let me put it in English for you. Hey, option 1, you are 500 to 1,000% more likely to be audited than option 2. And as a bonus, you're going to lose those audits 94 to 95% of the time. Option number 2, you're going to be audited once every 500 years on average. And if you're audited during your lifetime, you'll lose those 62 to 71%. So you'll never be audited. It's rare, once every 500 years. But more importantly, it's you also pay less tax. When I put them side by side and I go and say a sole proprietor versus an S corp, I can literally run the numbers. Let's say it's Toby's Pizzeria, and this is the sole proprietor. This is the S corp. All things being equal, without messing around with a bunch of different things, I look at the 199A deduction. All you accountants out there, I'm looking at the employment taxes. I'm putting these things side by side and running them. You're going to save on $50,000. You're going to get a 10% boost. You're going to get an extra $5,000 just because I made an S selection. I run that same thing on $100,000. My boost is at least 78, 77. And remember the example I gave you guys. There's ancillary benefits when you set up an entity like this. There's ancillary benefits that could still help you, especially if you're using retirement plans. This is the 2 types of returns. This is a sole proprietor, and this is an S corp. Those are the returns. Oh, the S corps are so much harder. I don't think that is accurate. Bookkeeping is the same no matter what your entity is. The IRS doesn't differentiate between sole proprietors, partnerships, S corps, C corps, nonprofits, or any business. Any business has to keep good books and records, period. It doesn't say, but if you're an LLC, you don't have to. Nothing like that exists. From the IRS standpoint, they're all equal. And so from our treatment of them, we treat them equally. And some people still go out there and try to do that. Accountable plan, when you have an S corp, by the way, you can actually pay for expenses. I'm just giving this quickly, and then I'm going to jump into some legacy planning. If you have an S corp and it reimburses things like your phone and your computer and your kid's phone, your kid's computer, and anybody that's working for you, their things, it's no different than if your employer, let's say that hopefully everybody here has had a job at some point.